In the past few decades, the information technology services industry has observed fast growth throughout the globe. It is experiencing a boom like never before, and more brands are looking to expand in this area because of the immense amount of potential. With this, we have selected three companies in the industry to conduct a cash flow analysis, namely International Business Machines Corporation, Leidos Holdings Incorporated, and CGI Incorporated. By conducting an accurate cash flow analysis, these firms can be proactive instead of reactive. Cash flow analysis determines the areas where cash is ample or scarce with timely updates to see the movement of money into and out of business. But before anything else, let's first take a look at each company's profile.
Let's get to know first the International Business Machines Corporation. So International Business Machines Corporation, better known as IBM, is one of the biggest technology companies in the world, providing integrated solutions and services with operations in more than 170 countries and over 345,000 employees worldwide. Accordingly, the company operates through four business segments, namely software, consulting, infrastructure, and financing. The software segments offer hybrid cloud platform and software solutions such as Red Hat and enterprise open source solutions. This segment also provides transaction processing software that supports clients' mission-critical and on-premise workloads in banking, airlines, and retail industries. Then the consulting segment offers business transformation services, including strategy, business process designs and operations, data and analytics, and system integration services, and many more. On the other hand, infrastructure segment provides on-premises and cloud-based service and storage solutions for its clients' mission-critical and regulated workloads. It also supports services and solutions for hybrid cloud infrastructure, as well as remanufacturing and remarketing services for used equipment. Meanwhile, the financing segment offers lease installment payment, loan financing, and short-term working capital financing services. So the second company is Leidos Holdings Incorporated. Leidos Holdings Incorporated, together with its subsidiaries, is a Fortune 500 information technology, engineering, and science solutions and services leader working to solve the world's toughest challenges in the defense, intelligence, civil, and health markets in the United States and internationally. Generally, the company operates through three segments, namely Defense Solutions, Civil, and Health. The Defense Solutions segment offers national security solutions and systems for air, land, sea, space, and cyberspace for the U.S. intelligence community. When it comes to Civil segment, the company provides systems integration services to air navigation service providers, including the Federal Aviation Administration, the en route optimization modernization. It also offers information technology solutions in cloud computing, mobility, application modernization, DevOps, data center, network modernization, asset management, help desk operations, and digital workplace enablement and environment, energy, and infrastructure services. In the health segment, they offer solutions to federal and commercial customers responsible for health and well-being of people worldwide, including health information management, managed health, digital transformation, and life sciences research and development services. Lastly, the CGI Incorporated. CGI Incorporated, which is Canada's premier IT consulting and system integration company, provides information technology and business process in Canada, Europe, Australia, Scandinavia, Finland, Poland, Baltics, the United States, the United Kingdom, and the Asia Pacific. Its services include the management of IT and business outsourcing, system integration and consulting, and software solution selling activities. The company also offers application development, integration and maintenance, testing, portfolio management, and modernization services, business consulting, and a suite of business process services designed to address the needs of specific industries as well as IT infrastructure services. It serves the clients operating in government, banking, capital market, health, utility, communication and media, oil and gas, retail, consumer and services, space manufacturing, insurance, and many more.
So now, let's start analyzing this company's cash flow. The formula to compute the operating cash flow ratio is cash flow from operations divided by current liabilities. For International Business Machine Corporation, the cash flow from operation is equal to 12,796,000 divided by current liabilities of 33,619,000. So the operating cash flow ratio of the International Business Machine Corporation is 0.38. For Legios Holding Incorporated, the cash flow from operation is equal to 1,031,000 divided by current liabilities of 3,229,000. So the operating cash flow ratio of the Legios Holding Incorporated is 0.32. For CGI Incorporated, the cash flow from operation is equal to 2,155,928 divided by current liabilities of 3,803,472. So the operating cash flow ratio of the CGI Incorporated is 0.57. Based on the operating cash flow ratio, companies in IT services industry with a ratio greater than 1 are deemed desirable. In contrast, less than 1 indicates the company's volatile financial position, meaning it gained less cash from operation that was necessary to cover its current liabilities. Investors, creditors, and analysts prefer a ratio greater than 1 because it suggests good financial health, and its cash flow is more than adequate to meet short-term financial debts, while still having excess earnings. Thus, International Business Machine Corporation, Legios Holding Incorporation, and CGI Incorporation with ratio of 0.38, 0.32, and 0.57 are suffering from cash crisis. They have low liquidity which needs more capital to satisfy their current deficits. The formula to compute the price or cash flow ratio is the share price divided by operating cash flow per share. For International Business Machine Corporation, the share price is equal to 140.71 divided by operating cash flow per share of 14.25. So the price or cash flow ratio of the International Business Machine Corporation is 9.88. For Legios Holding Incorporated, the share price is equal to 99.35 divided by operating cash flow per share of 7.36. So the price or cash flow ratio of the Legios Holding Incorporated is 13.49. For CGI Incorporated, the share price is equal to 79.33 divided by operating cash flow per share of 8.78. So the price or cash flow ratio of the CGI Incorporated is 9.04. The average price or cash flow ratio for the technology sector, particularly IT services industry, is 13.35. Generally, when the price or cash flow ratio is low, it implies that the stock value is better. A high price or cash flow, on the other hand, indicates that a particular firm trading price is high. It signifies that there aren't enough cash flow to support the multiple. In that case, Legios Holding Incorporation with a ratio of 13.49 is the most desirable investment based on the average price or cash flow ratio, compared to International Business Machine Corporation and CGI Incorporated. Yet, International Business Machine Corporation and CGI Incorporated with ratio of 9.88 and 9.09, which is less than the average, are still preferable investments since they have low ratios. To compute the cash flow margin, the formula is operating cash flows divided by net sales. For International Business Machine Corporation, the operating cash flow is equal to 12,796,000 divided by net sales of 57,351,000, so the cash flow margin ratio of the International Business Machine Corporation is equal to 0.22. For Legis Holding Incorporated, the operating cash flow is equal to 1,031,000 divided by net sales of 13,737,000, so the cash flow margin ratio of the Legis Holding Incorporated is equal to 0.08. For CGI Incorporated, the operating cash flow is equal to 2,155,928 divided by net sales of 12,126,793, so the cash flow margin ratio of the CGI Incorporated is equal to 0.18. An excellent cash flow margin ratio in the IT services industry is usually greater than 50%. If a firm's operating cash flow margin is less than 50%, it indicates that it's not efficiently converting sales into cash and may instead have enormous expenses. According to the data computed, International Business Machine Corporation, Legis Holding Incorporated, and CGI Incorporated with 22% and 8% and 18% respectively cash flow margin, which is less than the ratio for excellent ones, implies that all the three companies have an effective translation of sales into cash.
Cash flow from operations or average total liabilities. To compute the cash flow from operations or average total liabilities, the formula is cash flow from operations divided by average total liabilities. For the International Business Machines Corporation, the cash flow from operations is equal to 12,796,000 divided by the average total liabilities of 36,744,000. So the cash flow from operations or the average total liabilities for the International Business Machines Corporation is equal to 0.35. For the Leidos Holdings Incorporated, the cash flow from operations is equal to 1,031,000 divided by the average total liabilities of 3,068,000. So the cash flow from operations or the average total liabilities for the Leidos Holdings Incorporated is equal to 0.34. For the CGI Incorporated, the cash flow from operations is equal to 2,155,928 divided by the average total liabilities of 3,729,648.50. So the cash flow from operations or the average total liabilities for the CGI Incorporated is equal to 0.58. The ratio of results indicative of a healthy firm differs by industry. A ratio of less than 0.5 is considered reasonable in the IT services industry. Investors and creditors frequently seek a firm with a cash flow from operations or average total liabilities ratio of less than 0.5. Companies in the technology sector commonly have less than 0.5 cash flow from operations or average total liabilities, because their cash flows are more volatile than those in other industries. Accordingly, International Business Machines Corporation and Leidos Holdings Incorporated with ratios of 0.35 and 0.34 are preferable since they are less than 0.5, unlike CGI Incorporated with a ratio of 0.58. International Business Machines Corporation and Leidos Holdings Incorporated with cash flow from operations or average total liabilities lower than 0.5 are financially flexible, implying that they can settle their obligations on time and be profitable in the long run. Current ratio. To compute the current ratio of the company, you have to divide the current assets to the current liabilities. For the International Business Machines Corporation, the current asset is equal to 29,539,000 divided by current liabilities of 33,619,000. So the current ratio for the International Business Machines Corporation is equal to 0.88. For the Leidos Holdings Incorporated, the current asset is equal to 3,619,000 divided by current liabilities of 3,299,000. So the current ratio for the Leidos Holdings Incorporated is equal to 1.12. For the CGI Incorporated, the current asset is equal to 4,765,138 divided by current liabilities of 3,803,472. So the current ratio for the CGI Incorporated is equal to 1.25. An excellent current ratio is usually between 1.5 and 2. If the current ratio is high, suggesting anywhere above 1, then the firm can cover its short-term debts. The higher the ratio, the better their ability to pay off liabilities. Ratio less than 1.00 on the other hand suggests that the firm's debts due in a year or less exceed its cash or other short-term assets assumed to be converted to cash in a year or shorter. Hence, Leidos Holdings Incorporated and CGI Incorporated with ratios of 1.12 and 1.25 are considered healthy, meaning they have adequate current assets to satisfy their current liabilities. However, with a 0.88 current ratio, International Business Machines Corporation does not have enough liquid assets, meaning it struggles financially to cover its debt. Quick ratio. The formula to compute the quick ratio is current asset less inventory then divided by current liability. For the International Business Machines Corporation, current asset less inventory is equal to 27,890,000 divided by current liabilities of 33,619,000. The quick ratio for the International Business Machines Corporation is equal to 0.83. For the Leidos Holdings Incorporated, current asset less inventory is equal to 3,345,000 divided by current liabilities of 3,229,000. The quick ratio for the Leidos Holdings Incorporated is for the CGI Incorporated. Current asset less inventory is equal to 3,720,080 divided by current liabilities of 3,803,472. The quick ratio for the CGI Incorporated is equal to 0.98. The industry average quick ratio is 1. A quick ratio of less than 1 means that the firm may be unable to cover its current liabilities due to a lack of liquid assets. It suggests to potential investors that the company is not yielding sufficient profits to cover its outstanding debts. A firm with a quick ratio greater than 1 on the other side has enough liquid assets that it can convert into cash to meet its current obligations, meaning its quick assets outnumber its current liabilities. The higher the proportion, the better off the company is. Therefore, Leidos Holdings Incorporated with a 1.0 ratio means the company is healthy and can pay its debts. It shows that the business is financially stable in the near term, wherein the firm is growing and selling well, and that its accounts receivable are being collected. On the contrary, International Business Machines Corporation and CGI Incorporated with 0.83 and 0.98 quick ratios indicate low liquidity wherein they have fewer liquid assets than liabilities. It can be because they have deliberate sales, many bills, and insufficient collections for accounts receivable.
Cash conversion cycle is equal to inventory conversion period plus receivables collection period minus payables deferral period. Inventory conversion period is equal to inventory divided by sales per day. Receivables collection period is equal to receivables divided by sales over 365 days. Payables deferral period is equal to payables divided by cost of goods sold over 365 days.
For International Business Machine Corporation, inventory is equal to 1,649,000 divided by sales per day of 157,126. So the inventory conversion period of the International Business Machine Corporation is equal to 10.49 days. For Leagios Holdings Incorporation, inventory is equal to 274,000 divided by sales per day of 37,636.62. So the inventory conversion period of the Leagios Holdings Incorporation is equal to 7.28 days. For CGI Incorporated, inventory is equal to 1,045,058 divided by sales per day of 33,224.09. So the inventory conversion period of the CGI Incorporated is equal to 31.45 days. For International Business Machine Corporation, receivables is equal to 14,977,000 divided by sales over 365 days of 157,126. So the receivable conversion period of the International Business Machine Corporation is equal to 95.32 days. For Leagios Holdings Incorporated, receivables is equal to 2,186,000 divided by sales over 365 days of 37,635.62. So the receivables conversion period of the Leagios Holdings Incorporated is equal to 58.16 days. CGI Incorporated receivables is equal to 1,236,388 divided by sales over 365 days of 33,224.09. So the receivable conversion period of a CGI Incorporated is equal to 37.21 days. For International Business Machine Corporation, payables is equal to 6,244,000 divided by cost of goods sold over 365 days of 70,863.01. So the payables deferred period of the International Business Machine Corporation is equal to 88.11 days. For Leagios Holdings Incorporated, payables is equal to 692,000 divided by cost of goods sold over 365 of 32,117.81. So the payable deferral period of the Leagios Holdings Incorporated is equal to 21.51 days. For CGI Incorporated, payables is equal to 1,052,025 divided by cost of goods sold over 365 days of 25,780.74. So the payables deferred period of CGI Incorporated is equal to 40.81 days. For International Business Machine Corporations, the inventory conversion period is equal to 10.49 plus receivable conversion period of 95.32 less the payables deferred period of 88.11. So the cash conversion cycle of the International Business Machine Corporation is equal to 17.70 days. For Leagios Holdings Incorporated, the inventory conversion period is equal to 7.28 plus receivables conversion period of 58.16 less the payables deferred period of 21.55. So the cash conversion cycle of Leagios Holdings Incorporated is equal to 43.90 days. For CGI Incorporated, the inventory conversion period is equal to 31.45 plus receivables conversion of 37.21 less the payables deferred period of 40.81. So the cash conversion cycle of CGI Incorporated is equal to 27.86 days.
Generally speaking, a shorter cash conversion cycle is better than a longer one in the IT services industry because the shorter the cash conversion cycle, the better the company is at selling inventories and recovering cash from these sales. It means that your business has greater liquidity and operates more efficiently, while a longer cash conversion cycle means that the business takes a longer time to generate cash, which can mean insolvency for the business. Hence, International Business Machines Corporation and CGI Incorporated have a cash conversion cycle of 17.70 and 27.86 days, which results in a shorter cash conversion cycle. That means that these two companies have greater liquidity. However, Leidos Holdings Incorporated has a cash conversion cycle of 43.90 days, which is a bit longer. They need to lessen their cash conversion cycle and make it shorter, just like the International Business Machines Corporation and CGI Incorporated when it comes to generating cash to avoid insolvency for the business.
Consequently, after considering all the required computations to tell if a company has good cash flows, among the three chosen companies in information technology services, Leidos Holdings Incorporated is the best choice. Compared to IBM and CGI, Leidos Holdings Incorporated has a higher price-to-cash flow ratio, indicating that it is the most desirable company to invest in. A cash flow from operations or average total liabilities ratio of less than 0.5, indicating that it can meet its obligations on time and be profitable in the long run. And finally, a good current ratio and quick ratio. However, the company needs to address and evaluate other areas, particularly its operating cash flow ratio, cash flow margin ratio, and cash conversion cycle to have an overall efficient and sound cash flow. In general, cash flow analysis is significant for a company since understanding cash sources and where its cash is going is vital for cultivating a financially sustainable business. And that concludes our presentation. Thank you for listening.